Hello, I'm Homa Rassouli. I'm a reverse mortgage specialist with Mutual of Omaha Mortgage. I have been a NAFA member for the last 10 years, and I had the pleasure of serving in a board in Marin County for a few years. I wanted to thank NAFA for having me today, and I appreciate the support and help from each one of you. I'm very passionate about how I can make a difference and educate and help homeowners over 62 years old to change and improve their retirement income planning by using their housing wealth and how they can use this FHA or jumbo insured program for refinancing, standby line of credit, or purchase program. I wanted to share with you 5 ways to secure retirement. Number one, alleviate stress on portfolio by eliminating principal interest payments. Replace the existing mortgage with a home equity conversion mortgage. This is another name for the reverse mortgage. What is reverse mortgage? Reverse mortgages was created in 1989 to help older homeowners meet the financial demands of retirement and aging in their home. It's a mortgage loan based on your home's value, the youngest borrower age, and the current interest rate. It requires no monthly mortgage payment, giving you an access to funds without the financial burden during your retirement years. You retain the title, the ownership of the house, as long as you meet the basic requirement of the loan. The borrower must occupy home as a primary resident and remain current on property tax, homeowner insurance, the cost of home maintenance, and any HOA fees. Number two, provide buffer asset to mitigate adverse frequency of returns. Establish standby HECM line of credit or reverse mortgage line of credit. The standby reverse mortgage line of credit is a retirement strategy where the homeowner uses the credit line as a bucket to draw from during bear markets. For example, I have clients that they are around 70 years old and they didn't want to use their portfolio, especially on the bear markets. So they establish standby line of credit to use that line of credit when it's needed. I have other clients that they are using standby line of credit for long-term care, because one of the benefits of the FHA reverse mortgage line of credit is the growth factor. So they were 70 years old and they didn't have long-term care. They established a standby line of credit. So when they're 80 years old and they want to use that funds, it's twice or 3 times as much as they started with. So it's a really great benefit. The third solution is the purchase retirement home without monthly mortgage payments. It's a portfolio invasion. Finance with the reverse mortgage for purchase. The home equity conversion mortgage for purchase or reverse mortgages is an FHA tool which permits for the purchase of a new home if they want to do right sizing, downsizing, upsizing, moving to the family, closer to the family. It's a one transaction allowing you to invest the difference to the retirement. Your down payment is determined by the home's purchase value, less available home equity conversion mortgage proceeds and loan costs. Even better, you don't have any monthly mortgage payments for your new home. So if there is a purchase program for people who wants to sell their existing home or buy a new house with a reverse mortgage with one-time down payment and no monthly mortgage payment. The only responsibility is pay their property tax, homeowner insurance, and HOA. So I have clients that they are moving to closer to the family. They are selling their existing home and purchasing a new house. So let's say if one of my clients sold their house for $800,000 and they are purchasing a house for $600,000 in another area, and they can use the reverse mortgage for $300,000. So that means that they can start saving a lot of money into their portfolio and use the reverse mortgage for purchase, no monthly mortgage payment required. The fourth way of securing the retirement is reducing portfolio draws without sacrificing spending. You can create annuity from housing wealth via Homa tenure plan, reverse mortgage tenure plan. How does this one work? It's a tax-free lifetime income stream, thereby reducing the need to make withdrawals from tax portfolios. How does it work? The reverse mortgage has several flexible payout options: a lump sum, partial lump sum payout, monthly installment payouts, or a line of credit, or a combination of these options. Your access to proceed is limited to the first year, but you will have access to remaining funds after this time. The unused funds in the line of credit are not charged interest until used, and your available credit line may actually increase each month when unused. The fifth way of securing retirement is hedge against inflation, property deflation, and unexpected expenses. Secure a growing home equity conversion mortgage or reverse mortgage line of credit at the qualifying age of 62. If you look at the traditional home equity line of credit from the bank versus the home equity conversion mortgage or reverse mortgage line of credit, you can see that there is a lot of benefits with applying for a reverse mortgage line of credit versus the home equity line of credit. The line of credit with HECM, with the FHA, cannot be frozen, reduced, or canceled in the ongoing terms of the loan. So if you remember, and now especially this time as well, that if you have a line of credit, it can be reduced, it can be canceled or frozen when the market is down. But with the FHA HECM line of credit, they cannot do that. So it's not going to be reduced, canceled, or frozen. Unused line of credit grows each month regardless of a home value. So that's one of the FHA benefits with the line of credit, that has a growth factor. And it doesn't matter if the market is low, if the home value is not there, it will be growing for the unused funds. Allow homeowners to access the equity in their home for funds they can use for any purpose while ongoing their home. With the FHA line of credit, there is no monthly mortgage payment required. If someone wants to make payments, they can, but there is no monthly mortgage payment required. There is very minimal credit requirements to qualify for this line of credit. There is very minimal income requirements, versus if you apply for a traditional HELOC or traditional mortgages, there is more requirements this day to qualify for the regular mortgages. And it's an age-based home loan, homeowner 62 and older. And it's a government insured loan, and it's a non-recourse loan. So what it means by non-recourse, if a husband and wife get a reverse mortgages, they can stay in the house as long as they want. The loan doesn't become due unless they sell the property or it's not their primary resident anymore. So if a husband or wife passes, another one can stay in the house, and when both of them passes, the loan becomes due. And at that time, their estate will sell the property, pay off the bank, and keep whatever is left. But if in any case, if the loan balance is higher than the home value, no one has to pay it back. The FHA will cover that. So it's a non-recourse loan. It's the safest product out there. I'm always available to help with any questions or concern. I'm Homa Rassouli with Mutual of Omaha Mortgage. I'm a reverse mortgage specialist in Bay Area. We can create loans in 43 states. Please give me a call for any purposes, and I'm here to help and assist you with your clients. Thank you and have a wonderful day.